Greetings everybody and welcome to class, and in this video we're going to talk about deductions for AGI, or as I like to call it, deductions above the line. Let's hit it. All right, everybody, so in this video we're going to talk about identifying common deductions necessary for calculating adjusted gross income. Now, actually, before I go to the next slide, let's talk a little bit about what Chapter 6 is, okay? So in Chapter 4 we kind of talked about an overview of individual taxation. In Chapter 5 we talked about, gross income. Now we're going to talk about what to subtract from gross income in order to arrive at, adjusted gross income, and then later on taxable income, so we can calculate tax. Now, something that's very important to understand with this, when it comes to deductions, there's really two groups, for lack of a better term. There's really three, but we'll stick with two for now, that we've always kind of thought about in the industry. And one is the above the line deductions, the ones we're talking about in this video. And then there's also one below the line deductions, okay? Now, what do I mean by the line? What is the line? Well, line is AGI. And where does this come from? Historically, tax forms, the 1040 tax form particularly, not really 1040A or 1040EZ, but 1040, the straight stick, was a two-page tax return. And so what would happen is you get down to the bottom, and you've got to remember, a lot of these tax reforms were actually made, decades ago when computers were not really as prevalent as they are in today's society right now. So what ended up happening is they had to kind of make things as easy as possible in the guy or gal who was doing the processing. And so one of the ways that they would do this is you'd get done with the first page of the tax return, get all the way to the bottom, which was your AGI, and then you'd flip it over, and they'd want you to copy AGI again at the top, so as the person who was processing the tax return didn't have to go flipping back and forth to make sure that the deductions correlated with the AGI. Because something you'll learn later on, particularly in video 2, is that AGI is a very important number when determining if you can take deductions or not. We have some of that in this video too, but really a lot more on the other side. And that's why knowing what AGI is on both sides of the paper really makes sense. Now, what we're going to talk about in this video is going to be what we call the above-the-line deductions. Now, as a hint, above-the-line deductions are seen as more valuable than below-the-line deductions. Now, the main reason for that is because above-the-line deductions, regardless of whether you are itemizing or using the standard deduction, we'll talk about that more in video 3, when you use one or the other. Regardless of whether you use the standard deduction or itemize, though, these deductions are available to you to reduce to get AGI lowered. Now, a second effect of this is that the lower we can make AGI, the more that's going to be allowed to be deducted in the below the line deductions, also the ones that are going to be on Schedule A. Okay, and that brings me to this point. If you want to follow along with some of the stuff that we're going to be talking about here, I would grab a Schedule 1, and I'd probably have a Schedule C and a Schedule E. Wouldn't hurt to have one of those as you're watching this video. If you're the first time, you don't necessarily need to have it. I mean, if you've got multiple monitors, go ahead and pull them up. But if you're watching this the first time, you don't have the ability to do it because maybe you're on an iPhone or whatever. Wait till you get home, and then also at that point, go ahead and have a printout and then watch it again so that you can kind of get over this. Okay, and I'll try to make this video as short as possible. Last time I shot it was like 30 minutes. But I'm going to try to shorten that up a bit. But I think having that global overview as to what exactly we're talking about here will help us make sense. Because, when I talk to students about above the line deductions, below the line deductions, what's here, what's there, they're like, I don't get it. And I think part of the problem that we have with this is that we've moved away from, as a teaching industry, really going back to the forms. And if you understand what's on which form, I think it makes it easier to be able to take the deductions, and so I'll try to talk to it as though it's that. Now, if you're curious what Schedule 1, I do have a video that talks about the 1040 Schedule 1. I believe we talk about Schedule 2 and 3 also. As an overview, it's a concept video. You can watch that. And then I also have a concept video over Schedule A. Okay, those are going to be very helpful if you're really trying to understand how these things work. Okay, so the three categories of the book gives you for deductions for AGI: directly related to business, indirectly related to business, and subsidizing specific activities. Now, if you ask any CPA which deductions are for AGI or above the line deductions, as I like to say, they're probably going to refer to bullet point 3, because bullet point 3 really is in this section of the tax return listing out deductions. Now, it's kind of a misspeak because deductions take place at other portions of the tax return. So in Schedule C, which is for business tax returns, you'll have income, and then you have a whole bunch of deductions. You know them as expenses. That's a deduction. Okay? When you go to the Schedule E and you're doing a rental property, you have rental income, and then you have a whole bunch of expenses or deductions. Okay, so that's what they're kind of talking about here when they're talking about, directly related to business activities. Now, we don't talk about rental properties too much in this court. Actually, if there's one thing we really probably should talk about, it's how rental properties get taxed and how they're taken care of. I don't know why we don't do it. And actually, by the way, it's not George Mason that's not doing it. I think it's really the industry as a whole, the education industry. I do have some videos where I kind of talk about some of the aspects of that. They're not really pieced together, but they are aspects that are talked about. And then when we have the indirectly related, we'll kind of get it more into the devil's in the detail. But when subsidizing specific activities, what do we mean by that? So, for example, if you're self-employed, we want you to have health insurance. So they're going to give you a tax deduction for that. If you're self-employed, we want you to contribute to a retirement savings account, because you don't have a company that's going to do it for you. You have to go do this on your own. So to do that, we have to give you a deduction to do it. Now, don't go out there and think, well, those deductions are only for self-employed people. You, as an employee, get a deduction too. It's just that it's done differently because the deduction to a 401k comes right off the top. In fact, if you ever take a look at a box 1, box 2, box 3, box 4, box 5, box 6 of a W-2 and wonder what's the difference between federal tax and income tax wages and Social Security and Medicare tax wages, oftentimes it's 401k deductions, because they comes right off the top. You don't see that on your tax return. But a self-employed person doesn't have a W-2. So that they have to delineate and show that out more. So don't look at some of this stuff and say, well, why do these guys get it and I don't? Well, that's not true. Okay, it just may be in a different area. Okay, so don't focus on it. Anyways, I don't know why I keep listening on these news programs where they keep everybody's complaining that some people get deductions and others don't. There might be a reason for that. And before you start spouting off, not you, my students are brilliant. They would never do something stupid like this. But, in the news media, if you're going to spout off, this is not fair for these guys to do, you might want to take a look as to why we're doing it. All right? Sorry, my rant. Directly related to business activities. What do I mean by this? So, Schedule C, where you're self-employed in a business, or if you have a rental activity, those are going to be, that's where they're kind of calling for investment activities. They can also talk about partnerships, S corps, all that sort of stuff can also fall into that. So it can be a trade or business. So for example, if I'm a real estate agent and I go sell a house I sell people houses, or I help people buy houses. I have income that I receive, the commissions, and then I have expenses that I incur in order to be able to continue to do that activity. Okay. For tax purposes, activities are either profit motivated or motivated by personal objectives. Now, profit motivated are going to be business activities and investment activities. I believe they talk about on the next one. Let's see. Yeah. Well, sorry about that. Okay. The one that they're saying that are more by personal objectives, that can actually be what's referred to as hobby income. They don't really give you many deductions for that anymore if we're talking about hobby income in this. And if you have any questions about what hobby income is, you can look it up on the internet. We don't talk about it too much in this class because in the old days, this used to be the big topic. Are you doing a business because you really want to make money, or are you doing a business because you're trying to, you're doing something that's making money, but it's not really your profit's not your motive. And I think a very good example of this, we see this in the military a lot, where officers were moving around every 3 years. And while that's good for them because it helps for the career development, the spouses, it kills their career opportunities because if you're moving every 3 years, you don't really get to stay in a company long enough to develop and grow. Now, I would say in today's world, people change jobs so often, it's not that big of a deal. But anyways, don't get me started on that. So what would happen a lot of times is that these spouses were like, I want to do this business. So they do things like being an Avon person, where they buy makeup from Avon and resell it to people by having these makeup parties. Or they become a pampered chef person where they could sell expensive cookware to their friends. They'd have pampered chef parties. They get together and they cook together and they use it and they're like, yeah, it's really good stuff. Why don't you go buy it? Okay. The problem that you ran into with a lot of these things, sometimes people were becoming Avon representatives because they wanted to buy the cheap makeup. And if they could sell it to their friends and make money, well, that's fine. But the real reason why they were doing it is they wanted an expensive makeup. Okay, that's not really a profit motive. So the IRS would basically say that's a hobby. Now, how's that treated? All income, gross income, is taxed at 100%. It's 100% taxable income. The expenses would have to be taken as a below-the-line deduction subject to 2%, but those got suspended with Tax Cuts and Jobs Act. We'll talk about that in video 2. But if a business gets reclassified as a hobby, you cannot take deductions. That's it. That stinks. We don't want that to happen. So that's why we have to talk to our clients and say, look, in order for this to get treated as a real business that you want to make money off of, you need to do these things. And so that's one thing we do require to have them understand. Anyways, they talk about trader business. Now, there's actually two different types of trader businesses. You have actual trader business, then you have what's called production of income. For the most part, they're treated the same. For purposes of this class, pretty much treat them the same. There's a little nuanceical differences. In an advanced tax class, I'd probably talk a little bit more about it, but not here. But the difference that you might see in is, anything on a Schedule C is generally going to be trader business. Anything that's on a Schedule E related to rental properties is going to be production of income, or royalties can also be a production of income. So I have a piece of land. I go out, poor old Jed was out shooting at some food, missed the squirrel, and up come bubbling crude. And if you are old enough to know what that song references, you're as old as I am. All right, the Beverly Hillbillies, folks. That's how he discovered oil. The next thing you know, he's moving to Beverly Hills because that's what he's told he had to do. And so, with the oil, oil companies come in, they pull the oil out of the ground, they pay good old Jed a whole bunch of money because it's his land and it's his oil, but they're going to buy it and sell it. Okay, so that would be primarily motivated by profit. Investment activities can also talk about property appreciation. Okay, and so when you're talking about rental activities, so I said in a trader business, if you're not really serious about this, the IRS will come after you. And the rule that they do with this is actually a 3-year rule. So if the business loses money 3 years in a row, they're going to start asking questions like, do you really want to make money at this? And if you don't, we're going to pull you. Okay, we're gonna say it's not a business, it's a hobby. You got to reclassify, and we're going to make you pay taxes on all that income, no deductions. Okay. With rental properties, the IRS takes a more global view. Yes, the income that you bring in minus your expenses should be profitable. That's what the IRS wants. That almost never happens for most taxpayers. And the reason why is because depreciation expenses are so high, they're going to have a tax loss. Now, the IRS is okay with that because the IRS is saying, look, in addition to you wanting to make money off of this and pay for your expenses as a result of having the property, we know that your real goal is to make as much money as you can off that and capital appreciation on the house. Okay? That's important for both. So they give you that as kind of the understanding of that. So they give you a little bit more time to move that through. This is a good chart in order to be able to see it. Like I said, business activity, self-employed, business deduction for AGI, that's your business expenses. You'll have none from AGI. That's a good thing, believe it or not. We'll talk about that in the second video. Investment activities, rent and royalty expenses will be your deduction for AGI. In other words, the above the line deductions. Your below the line deductions will be investment interest expense. We'll talk about that in the second video. And then not deductible. The Tax Cuts and Jobs Act took a lot of deductions that they used to get, including unreimbursed employee expenses and other investment expenses, and basically they're subject to a 2% floor. We'll talk about what that means in the next video. But the Tax Cuts and Jobs Act suspended those until 2026. Now, in previous videos, I never talked about that because I thought Congress would be stupid not to go back and look at this again. I am convinced that they're not going to get anything accomplished in that area until after this election that's coming up in 2024. But it's going to depend on who wins as to which direction it goes. Okay, so you got to pay attention to that. And God help us if we have one party in the White House and both and different parties in the Senate and the House. That's just going to make it even more likely that not as much is going to get done unless they have a kumbaya moment and get together. I'm not seeing it. All right, trade or business must be directly related to the business activity. You'll claim your expenses on Schedule C, and then it'll go from Schedule C to Schedule 1. Okay. Now, if you guys are like, why do they go Schedule C to Schedule 1, blah, blah, blah. If you take a look at what Schedule C and Schedule 1 is, and again, look at the concept videos, you'll understand how that flows. But Schedule 1 originally didn't exist. This is only a brand new form that came out only a few years ago. Okay. Prior to that, Schedule C income went directly to the 1040. Okay. But they've broken it off and created these different schedules. Okay. Rent and royalty expenses, they'll actually go on Schedule E. It could be either an investment activity or a trade activity, depending on the facts. Rental properties are sort of a blend of both. The difference is that the code section relating to business expenses is Code Section 162. The code section related to production of income, which is what they're kind of talking about here, is Code Section 212. And there's various rules and regulations that you got to look up on that. And again, if you end up going into tax, it might not be a bad idea for you to learn about that. Then there's flow-through entities. That's going to be your partnerships, your S corporations, and your trusts that kick out K1s. That's going to be really important, and you put those on the back of Schedule E, back of page 2. It'll flow the income down and then go back to page 1 before heading over to Schedule 1. Again, if you take a look at the video, you'll learn all that stuff. Okay. All right, losses. Now, if you're disposing of trade or asset losses, now we'll talk really. I wouldn't worry too much about losses on the sale of assets. We'll talk about that in Chapter 11, so it's not really as important right now. Losses from investments called capital assets are offset against capital gains. We'll talk about that more in Chapter 7. Okay, so they're going to learn that there's two different types of capital assets in tax. There's straight capital assets, which is I go out and I buy a stock and I buy it and I sell it. The difference is gains or losses. Okay. With a business asset that I use, so for example, if I go out and I buy a car and I use the car in my business and later on I decide to sell the car, that's going to be what's called the Code Section 1231 asset. We'll talk about that later on. It's a great code section. It's one of my favorites. But that's not what we're going to talk about until we get to Chapter 11. Just know this, probably the most important thing is that last bullet point. Net capital loss deducted for AGI, but is limited to $3,000. That's important for this chapter. That is important for chapter 7. Know it cold. All right, excessive business loss limitation. I'll be honest. My entire career, I've never run into this. Now, of course, I usually don't have extremely rich clients, so not. Well, I mean, I've got some that are pretty big, but like where I could see this being a case, if you've got two people who are married, and one has a W-2 at a law firm, and they make $1.5 million, which I've seen that before. And then the spouse runs their own business. Well, if the spouse runs their own business and they have $750,000 loss in their business, they can't take more than $578. Now, if that the delta between the $578 and the $750,000 that carries forward in the next year, but what they're trying to do is they're trying to have it to where you can't drill it down too much and a person makes $1 million and then walks away. I don't know why they're doing this personally. I mean, my personal opinion is if a person's losing $750,000 in cash and they're eating into their savings, they probably need that. But anyways, it's not for me to judge. Again, I'm a tax accountant, not a tax congressperson, so I'm good with that. But that's how that works out. Health insurance deduction by self-employed taxpayers. Okay, deduction. Basically, we want you to get health insurance if you're going to be self-employed individual. Now, one limitation of this, you cannot take this deduction if you have health insurance through other means. So, for example, if you run your own business but your spouse works through a company and can get health insurance through there, you need to get health insurance from that person. Unless their health insurance says, we won't insure you. And in that case, you can go get the insurance all you want. But like if I quit working at George Mason and just go 100% self-employed, my wife has insurance from her company. I can hop on her insurance and it's no issues. Another way this hits people, if they're retired government or if they're retired military or if they're a veteran from the military, because all three of those have access to health insurance provided by the government. Okay. Now, one exception to this rule is Medicare doesn't count. So the person gets to be, we'll say 75 or 65 years old, and they're still vibrant and young, and they want to run their own business. They still want to work because they really love what they do. The Medicare insurance actually becomes your self-employed insurance. It's actually one of the few really cool things that you can see with that, and that happens. Self-employment tax deduction. What is this for? You will pay social taxes. Everybody pays social taxes, whether you work as a W-2 or as a self-employed individual. And we'll talk more about this in Chapter 9. But what happens is, when you go to work, take a look at your W-2. By the way, those if you're in my spring of 2024 class and you're watching this video, your W-2 probably just came out. Take a look at it. You'll have box 1, box 2, box 3, box 4, box 5, box 6. Box 1, 3, and 5 are going to be wages. Box 4, 5, and 6, 2, 4, and 6 are going to be withholdings. Okay, so box 1 is your federal income tax, taxable income. Box 2 is the tax withholding. And then you have Social Security tax, taxable income, tax withholding. Medicare wages, tax withholding. You see what I'm saying? So that tax withholding, everybody is on the hook for 15.3%. And so what happens is you have to pay 15.3% of your income. Now, you pay half and your employer pays half. Okay? So if you decide you're going to quit and go self-employed, the IRS never goes without. They're going to charge you both halves for that. But here's the thing. When your employer pays yours half of self-employment tax, it's a tax deduction from income taxes for them because it's a necessary cost of doing business. I have to have employees. When you're self-employed, the IRS goes, not IRS, but also Congress, hey, the employer half of this, we're going to go ahead and give you the deduction for that. So that's actually a good thing. All right, deductions for retirement accounts. If you make a contribution to a traditional IRA, or there's actually a few others, employee benefit plans like simple IRAs, SEP IRAs, whatever, you can take a deduction for these. Now, fact of the matter is, the traditional IRA, There's income limits if you are covered under a retirement plan. If you're not, you can make Bill Gates money and make a contribution and still take a tax deduction for that. Okay. Limits change every year. I think for 24, it's going up to 7,500 for normal people, and then 8,500 for us old folks who are 50 or older. Okay. You can't now if you make too much money and you contribute to a 401k at work, you can still make non-deductible contributions. If possible, I'd say roll it over to a Roth IRA as soon as possible, but there's ways to do that. Again, if you're looking at something like this, talk to a tax advisor. If you're not in tax, and if you are in tax and you want more questions, answers about this, just reach out. Deductions for HSAs. What that means is this. The video is kind of going long, so I don't want to get too much in the weeds. High deductible plans, what are they? Health insurance is expensive. So the Bush administration, I think the Bush administration was the one who came up with these, really came up with this idea. We want to do health savings accounts. And so what they did was they said, look, we want you to go out and buy health insurance. We know it's expensive, but what we're going to do is that we're going to let you buy these things called high deductible plans. So maybe you buy a plan that has a deductible of $3,000, which is high. What that means is the first $3,000 that you pay for medical expenses, you're responsible for. Okay? Everything after $3,000, and again, I'm oversimplifying this, but everything over $3,000, they're going to cover most of, if not all. Okay? Then you're like, well, wait a minute, what about the first $3,000? I don't have $3,000 lying around. Okay, well, here's what they do. You couple it with a health savings account, and you can make monthly contributions to the health savings account, get a tax deduction. The health savings account investments are put into relatively safe investments. So you're talking like high interest money market accounts, maybe some low risk corporate bonds, investment grade bonds or something, mutual funds or whatever. And they're very highly regulated what they can invest in. You can't go buy options on this, okay? But you do that and it can grow money. And here's the kicker, folks, especially for you guys who are younger. If you don't go to the hospital, this money stays in the account and it grows and it rolls over for you. So if you don't do the doctor visits that often, and you know, usually the high deductible plans will at least cover a physical, and that doesn't require a deductible. That they'll just pay for the first physical that you do. And say you just go to the physical, they take your blood, they look at you and they say, yeah, you're fine. And then you never get sick, you don't go to the doctor, so you put your $3,000 in every year, and then you do this for like 2 or 3 years. Next thing you know, you got $12,000 in the account. Well, I don't have to buy a $3,000 high deductible plan. I can buy an $8,000 high deductible plan because I'm not going to the doctor that much. You see what I'm saying? And that can even reduce your costs even more. So it makes it a lot cheaper. It's a great idea. If you have any questions about this, reach out to me. I'm happy to talk about it. You make the contribution, get the tax deduction. If you pull it out and you use it for something other than health, and actually I had a client, they did this. She pulled out the money and used it for some cosmetic surgery. Ended up paying not only the tax on the earnings, but then also a 20% tax on top of it. Was not a smart move. In full disclosure, she did not reach out to me before doing this. Actually, I picked her up as a client afterwards. Alimony. Starting January 1st, 2019, if you get divorced and you are required to pay alimony to your spouse, you get no tax deduction for that. Okay? Spouse receiving the money doesn't pay tax on the alimony. Okay? In the past, and all divorces before January 1st, 2019, if the spouse pays child support, okay, gets a tax deduction, and then the other spouse has to pick it up on their income tax. Okay, look, this is going to be a problem for about another 5 years. After this, you're not going to see very many divorces that have lasted that long. Especially because what happens is oftentimes in divorces, if the other spouse who receives the support remarries, she usually loses the support. Okay. Deduction on qualified education loans. Yeah, your school loans that you have here, you can get a tax deduction for it, but be careful. Once you start making that $75,000 or more, which in this area is not hard to do, you start getting limited on it. And then once you make more than $90,000 of your single, $185,000 of your joint, then you lose it completely. Okay. This is a summary for the law for the interest deductions, and this is your phase outs. These are the phase outs based on for the interest deductions based on your filing status. All right, folks. So I try to keep it as little as possible, and I apologize it went as long as it did. If you have any questions, feel free to reach out to me. This can be really complicated stuff, and we kind of hit it at a very high level. I'd really read the book. I'd see the concept videos on this one. Because I think if you understand the forms and you go down the forms, you're going to pick this stuff up and you're going to know it cold. Okay, and you're going to be able to pass the test. Well, I want to say thank you very much for watching this video, and I look forward to seeing you in class.